Are you betting everything on equities or playing it safe with diversification? In today's video, we are diving head to head in comparison of two powerful investment portfolios. One is the portfolio A and the other is the portfolio B. Portfolio A consists of 100% Indian equities and the benchmark is NSE 500. And portfolio B consists of Indian equities, US stocks, gold, silver as well as fixed income. We will break down these portfolios on the basis of the past performances for the 1, 3, 5, 10 years as well as the risk and their maximum drawdowns. And most importantly, which one aligns to your financial goals. So if you are confused between maximum growth and strategic stability, you are in the right place. So don't forget to like, subscribe and hit the bell button. Let's get started. So here you can see two portfolios. Portfolio A, which is 100% equity and the benchmark is NSE 500, and the second is portfolio B, which consists of 65% equity, that is Indian equity, 10% US equity, 10% gold, 10% fixed income and 5% silver. So we have given a weight to each of the categories. Now the returns you see for the last 10 years, the CAGR returns for the portfolio A is 12.5% and the portfolio B is 11.42%. Portfolio A has been able to deliver better returns though investing in 100% equity, but portfolio B has been able to deliver 11.42% returns. If you see for the 1 year, portfolio A, which consists of 100% Indian equity, has delivered 20% returns. 3 years it is 15%, 5 years it is 13% and 10 years it is 12%. Comparing this with portfolio B, it is 14%, 13%, 12% and 11%. Reason is it is a very diversified portfolio and it is a very strategic portfolio compared to 100% equity portfolio. So if you compare the returns part, it will give you better returns. The reason is it is quite aggressive portfolio. Now coming to the risk part of the portfolio. Risk part is the volatility part. The risk of portfolio A, which is 100% equity, is 18%, which is very high. And compared to portfolio B, which is moderate, it is 12 to 13% rate. So now if we see the comparison for 1 year, 3 year, 5 year and 10 years, you can see on the chart the risk of portfolio B is quite less. In portfolio A, which was 100% Indian equity, the risk is quite high. So the higher the risk, higher the return. This is what we have tried to make you understand, that if you take a higher risk, you will be able to make higher returns. And whenever we are investing in Indian equities, your risk is quite high. Hence, you are compensated with the higher returns. This is on the chart. Again, if you see, the diversified portfolio is giving lower returns, but it is having a lesser risk compared to 100% Indian equity, which is high risk, high return. Now, if you see the Sharpe ratio, which is the risk adjusted return, the risk which you take on your investment and the return which you get on your investment is higher in portfolio B. Reason is you take lesser risk and you get a good risk adjusted return. In portfolio A, you are taking quite high risk. So the risk adjusted return compared to portfolio B is quite less. So whenever you are looking at a portfolio, you have to understand it is not only the returns. Returns is a byproduct of the risk that you take. So when you see the Sharpe ratio, which is the risk adjusted return, portfolio B will be able to deliver you better returns. Now if you see the comparison for 1 year, 3 year, 5 year and 10 years, portfolio B will be able to deliver better risk adjusted return on all the horizons, be it 1 year, be it 3 years, be it 5 years or be it 10 years. So that is the beauty of diversification and that is the beauty of having a different asset class into your portfolio rather than investing 100% into Indian equities or having an equity portfolio. You will be able to generate better risk adjusted returns. Now when we talk about the market crash impact, the max drawdown, whenever there is a big market fall happening in the equity market, the portfolio A, which was 100% Indian equity, will fall by max 40%. Vis-a-vis, if we are diversified well enough, this portfolio will not fall more than 20%. So we are not impacted by the market crash, and with terms of the returns we are able to deliver better returns. Now if you see the comparison for 1 year, 3 year, 5 year and 10 years, for the 10 years we have understood that the market will fall by 38% to 40% for portfolio A and for 20% for portfolio B. So this is the max drawdown comparison. So diversification and stability, portfolio A has a very concentrated risk, and because of that concentrated risk it is quite volatile. Now we compare it with portfolio B, it is a very diversified portfolio. All the asset class have very lower correlation with each other, hence it is quite stable. On a longer horizon, if you see the returns that you are making will have a hardly difference. So the conclusion is portfolio A will be able to deliver you higher returns but will carry higher risk, and it is best for aggressive investors. Portfolio B will have a balanced returns, have a better stability, and will give you good risk adjusted returns. Now the recommendation is you have to align your financial goals accordingly and then invest. Whenever you are investing, either it can be a portfolio A or it is a portfolio B. If you are investing in 100% in equity and if you have not invested in any other asset class like an US equity or silver or gold or even fixed income, you have to understand that you will be taking higher risk, and if you want to achieve your goals which are nearby, then it will be very difficult to achieve that financial goal. Because of that reason, if the markets are falling, you will not be able to achieve your financial goals. So whenever you are planning your investments, these are the two portfolios, portfolio A and portfolio B, that you have to understand and invest accordingly. So calculate your risk tolerance, calculate your return expectation, and calculate your time horizon and invest accordingly, either in a portfolio A or portfolio B. You can always change the percentage of allocation in your portfolio and make your investments. So guys, that's it from my side. Thank you so much for listening. Signing off, Mahendra Rao. Until we meet again. Bye bye.